is if we just scroll down to the market cycles here, we naturally see this blue cycle top out. That's the stock market tops out first, because investors can see reducing sales and profits and earnings and all that. And then once the stock market starts to sell down, then suddenly the yellow cycle, which is the economic cycle, it eventually tops, and we start getting, bad GDP numbers. We see earnings and downgrades, all that happen, and all of that stuff. So we're in this sweet spot right here where precious metals are on fire. Yeah, well, there's definitely a lot going on in the precious metal space, and it's not just the precious metal space. There's a lot of things outside of it, I think, that are warning us that I think we're getting close to an economic top. I think we're getting very close to a precious metals peak as well, and an equities market peak. So, the volatility that we're seeing today in precious metals, which is December 29th, we've got gold down 4%, which is a huge move for gold. Silver's down over 6%. We've got platinum and palladium like plummeting. We've got platinum from the highs of this morning down 20% for palladium. And I actually think platinum almost as well. So we're seeing this big volatility. We saw this last week as well. We saw about a 12% reversal in platinum and palladium. And those are all signs. When you see a 10 or 11% rally followed by a 12% sell-off and then a big rally again, that's usually the sign of exhaustion. That's the bulls and bears. It's greed and fear. It's the sign that things are getting unstable. When things become unstable, they usually resolve to the downside. So we got to be very cautious here. The sentiment is very strong. Everybody's super bullish on precious metals. Everybody's all-time highs for everything. So it's hard not to be excited. I get more nervous when we see this price action, because this is like, okay, maybe this run is over. Maybe I thought we were going to actually see metals pop up. Well, silver did hit our $82 target this morning, and now it's reversed and got hammered based on a Fibonacci level. But overall, I'm kind of hoping we're still going to see metals try to recover and go higher. But the volatility that we're seeing over the past more or less 4 or 5 trading sessions are telling us that there might not be much left. And this is the problem when we're in a little bit of a bubble phase, is the market could still pop and rally the precious metals another 20, 30%. They could also drop 10 or 20 or 30%. And that's what makes it unstable and volatile and carries risk. So it comes down to, how do you manage your positions and risks so you don't take a big hit if it reverses? So that's where we're in right now. Everybody should be on high alert, as excited as we want to be and see gold over 5,000 and silver break like 100 or something like that. Those are some sweet dreams. They may happen, but you got to have a strategy in case it doesn't, right?
Extreme enthusiasm often precedes major corrections. Right now, optimism around precious metals is everywhere. Gold targets above $5,000 and silver dreams of triple digits dominate conversations. That excitement is understandable, but it's also dangerous. When everyone agrees prices must go higher, risk quietly increases. Violent up and down moves reveal a tug of war between greed and fear. Markets in this phase can still surge higher, but they can also collapse just as fast. That uncertainty is what defines late-cycle behavior. Managing risk becomes more important than chasing upside, because the next big move could arrive in either direction.
Yeah, I believe we're in it right now. Like I'll share my screen and I'll show you kind of this last parabolic phase that I feel like we're entering in. So if we take a look at the left chart. Now the left chart, the candlestick is the S&P 500 weekly chart going back to the 2007 stock market peak. The yellow line is gold. And my expectations leading up to really last week was, I believe we'd see the stock market start to sell off, because the stock market did sell off about 20% in 2007 and the beginning of 2008. And we saw all that money come out of stocks and move into precious metals. Now, when we fast forward and look at where we are on the right-hand chart, that's where we are today. Very similar. Both gold and stocks have rallied. The thing is, we're seeing precious metals really pop and take off, and we haven't seen the stock market pull back. And I think a big chunk of this has to do with the Magnificent Seven, the big techs, the AI kind of bubble holding the value up and not giving us this downward move so much to feed into precious metals. And so that's where there's a big disconnect. And if we were to look at a lot of these different charts, if we look down below on the left-hand side, we got the gold and silver miners index. We've got silver, we got platinum and palladium. Well, last time we saw them all have this great big spike and peak as the stock market sold off and gold rallied. Well, if we look at where we are right now on the right-hand side, we've just had that big, huge peak and this blow-off top, it feels like. And the reversal price action we're seeing now feels like maybe the top is almost in. And so, as you just mentioned, I talked about how there's one last push. Well, that one last push has more or less happened over the past 3 or 4 weeks. And things have really taken off. I think gold might hold its value and push a bit higher. Well, maybe the more speculative metals like silver, platinum, palladium, and miners might pull back. But I think we may have just had that, and that's the big question: is do we have a high volatility, some big pop and squeeze to the upside, or did we just see that more or less in the last week, and now we're starting to see that reversal because the weekly charts are showing some huge selling going on, very similar to what we saw over here when they put in a major top, and they all sold off. We saw gold, silver, miners, platinum, palladium, they sold off pretty much all over 60%, most of them 70% from this phase. And of course, it was at a time where nobody thought metals were going to fall. You know, the dollar was beat up. It was very low, very similar to what we actually have right now in the markets. So I'm a little concerned for the precious metals space. I hold a lot of physical metals, and now I'm on high alert of, okay, we need to watch this closely, because if it doesn't recover and it continues to show high volume selling and bearish price action on the daily, weekly, even the 30-minute chart, I might be moving away from the precious metals space because we could go into a bigger correction. But that's obviously not the mass psychology. Everybody is probably going to buy this dip still and hope it's going to go a lot higher.
History doesn't repeat perfectly, but it often rhymes. Comparing today's environment with past cycles reveals striking similarities. In previous market peaks, stocks began to weaken first, capital rotated into metals, and speculative assets surged late in the cycle. Today, precious metals have already experienced explosive moves, yet equities have not meaningfully corrected. A handful of mega-cap technology stocks continue to prop up the broader market, creating a disconnect. When multiple metals peak together while stocks remain elevated, it raises concern. Similar conditions in prior cycles were followed by sharp reversals across commodities, miners, and eventually equities themselves.
For sure. But the thing is, it's not about picking a top, right? Like we all wish we could sell near the top, but the problem is you do need a sharp pullback. You do need price to start to build a bearish price action and start to actually, for the trend to reverse. You're not going to get out at the top. You're going to let price is going to pull back. It's going to start to head lower. The trend is going to change. And then you're like, okay, now the trend is down. I need to get out, right? So as much as we'd all love to get out at a peak, you are always going to give back that top kind of pop and drop price action. You just have to know that that big final rally and then sharp reversal isn't really yours to be had unless you're a trader and you're trying to pick a top and bottom, which is a loser's game in the long run. So you have to just accept the fact that, hey, silver popped to 12%, the previous session, and it gives it all back the next session. That wasn't really yours. That's just the price action that's telling you it's topping, and you're probably going to get out still a little bit lower as price breaks down and shows a bit more weakness. So I think that's where a lot of people get confused. They naturally think they should be getting out near a high. They don't want to sell as it has a sharp pullback and starts to reverse. But actually, that's just the beginning, because if you don't get out, these markets can sell off very, very dramatically. You look at silver down 61%, platinum down 67%, palladium sold off over 70%. So you got to be very cautious. Even miners on average sold down almost 70% as well. I'm not saying they're going to pull back that much, but we're in a similar situation in terms of what price action and sentiment across the board. It's almost mirroring like it did in 2007. And there's a really good, I think, example here that I like to show, because a lot of people don't quite grasp this. So let's just step back and look at the QQQ. This is the tariff sell-off this year in February, March, and April. Now, a lot of people said this was, very unique. It was tariff-driven, which it was. But when we look at this price action chart, this is my strategy. It tells us when the momentum has changed, when selling has kicked in. We're able to avoid the market and profit as it goes down. We can re-enter at a new lower price and ride the next trend. But this is where I want to explain the precious metals space. People keep saying, Chris, this is nothing like 2007 for the precious metals space. This is a totally different game. Well, If we take a look at this next chart, the top one is the tariff of this year. The bottom one is COVID. They're almost exactly the same. The stock market moves based on fear and greed. And it doesn't matter if there's tariffs and people hit the sell button, or if there's COVID and they hit the sell button, or if there's a financial crisis and they hit the sell button, or a tech bubble. The sell button is the sell button. It's people dumping shares, it's fear. When they buy, they all buy the same thing. So it's better to follow price action, and who cares what the news is? I trade pretty much without news. It doesn't factor into anything we do. Price tells us everything. That's how we make money as investors. Just follow price. If it's up, own it. If the trend is down, get out, find something else, or profit from it. And so this is the big scenario of what people need to realize. Yes, 2007, totally different in terms of economic climate, what's going on in the precious metal space. But in the grand scheme of things, it's the same type of thing. And if you look at these bull and bear markets, this is the S&P 500 monthly chart. The tech bubble fell 50%. The S&P 500 fell 57%. Both of them are pretty much the same thing. Just some take years, some take maybe not as long to reverse. But cycles are the same thing, and we can track the market. We can identify when there's a bull market, when there's a bear market, bear market, and that's what people need to understand. And when we take a look at the Benner cycle, which maybe you and I get into later, we are coming into 2026, which is actually a similar cycle as 2007. And we're coming into a time where you're supposed to be locking in profits across the board in any asset, in almost every asset, real estate, stocks, precious metals. We're going to see a lot of things take place. So there's a ton of stuff unfolding right now that people need to be aware of. And the precious metal space it's easy to get sucked into it, especially if you just tune in to precious metal bulls. They're always going to paint the bullish story that silver and gold's going to go to the moon straight up here, and this time is different. It's always, everybody says the same thing every time, but really price is price. If it keeps going up, well, you're going to hold it. If it does reverse, you're going to have a strategy to get you out, protect you, and then reload when the time is good for a new entry. That's the way I navigate the markets here.
Markets move on psychology, not narratives. Whether fear comes from financial crises, pandemics, tariffs, or bubbles, the result is the same. People sell. That's why price behavior matters more than headlines. Every major market decline begins with subtle changes, failed rallies, heavy selling on high volume, and broken trends. Investors rarely exit at exact tops. Instead, they respond when trends turn lower. Those sharp spikes followed by immediate reversals aren't missed profits. They're warnings. The goal isn't prediction, it's protection. Following price action allows investors to step aside before losses compound dramatically.
Yeah, I think when the equities market does start to roll over and sell off, I think that's when we're really going to start to see the overall precious metals and miners sell off in a fairly big way. Actually, the best chart I think of this is, well, the QQQ is a good gauge, but also the Magnificent Seven. So if we look at the MAGS ETF, this is the basket of the Magnificent Seven. If this starts to break down, if it starts to break this low over here or this low, especially this low, we're going to see everyone from mass psychology, everybody who's piled into the Magnificent Seven, we're going to start to see them selling. And when they all pile in, we see big money, we see the stock market go higher. When they all start to flee and retreat and run for the exit door, we're going to see this sell off very precipitously because it's an emotional herd psychology kind of play to the upside. It's a crowded FOMO play. And of course, when it sells off, it's going to become a pure fear-driven move where people don't care what price they get out. And a really good indicator here is just look at the volume on the bottom here. Look at the big volume spikes. They're red volume pretty much all the big volume days. That's telling us there are some big institutions and big players starting to lighten their load. They're getting out of these. They're rotating out, putting the shares into the average investor who still thinks this market's going to go a whole lot higher. And eventually, when this market breaks down, the equities market is going to, I think, trigger, it's going to lead the economic data. So generally, we see the stock market top first. And a good example of this is if we just scroll down to the market cycles here, we naturally see this blue cycle top out. That's the stock market tops out first. because investors can see reducing sales and profits and earnings and all that. And then once the stock market starts to sell down, then suddenly the yellow cycle, which is the economic cycle, it eventually tops. And we start getting, bad GDP numbers, we see earnings and downgrades, all that happen, and all of that stuff. So we're in this sweet spot right here where precious metals are on fire. Energy stocks are holding up near all-time highs when we look at like OIH and things like that. Industrial capital goods, factories are super bullish, thinking this market is going to keep going. They're all buying equipment. These are all the signs that people are blind. They don't see what's going on, and the stock market is going to put in that top. And so that's what I am waiting for. I'm waiting for the stock market to crack and break down on the Magnificent Seven, on the S&P 500, the NASDAQ. Once that breaks down, the big question is, how low do we go? Is it a 20% correction, a 40, a 50, a 60? Obviously, it'll vary depending on the indice. If it's the S&P 500 or the NASDAQ, which the NASDAQ will be much more volatile.
The stock market often leads the economy, not the other way around. When equities finally break, economic data usually follows. Today, major indices remain in uptrends, but warning signs are building beneath the surface. Concentration risk is high, with massive inflows crowding into a small group of dominant stocks. Volume patterns suggest large players may already be reducing exposure. If these leaders begin to crack, selling could accelerate rapidly as herd psychology flips from optimism to fear. That kind of equity unwind would likely drag precious metals, miners, and speculative assets lower, at least temporarily.
Yeah, I think right now, believe it or not, it's still the equities market is still in an uptrend. So when we look at the SPY, all the moving averages are sloping higher. I think you still need to be long equities. I think equities are still to play. Now we're coming seasonality into a very choppy condition. January is a very volatile time. If we look at the seasonality of the S&P 500, right now we've had this holiday squeeze. We had this nice rally over the past week and a half in the equities, and now we're in this last couple of days of the year where it's going to be a little choppy. But it does show January is usually really choppy. And January is a very good barometer of if the monthly candle closes positive for January, it's usually a strong year for equities or a positive year. If it closes negative, it's a very bad sign for stocks for the year. And so a lot of people, I think, are going to be waiting for that January to see where we go. And we're about to walk into a volatile time. So I still like equities. I do feel like they're coming close to an end. I still like precious metals. I more so like gold over everything else because gold, when we look at this chart of gold, it's having a one-day pullback, but it's also a very emotional kind of pullback into a support level. So I think gold is going to hold its ground fairly easy. It's just getting hit with a wave of panic and some selling today. When we look at silver, it's down about 7%. It obviously has a pretty big reversal-looking bar. It rallied 13% from the previous session. It's down 11% today from the high. If we look at platinum and palladium, so platinum's having a big reversal. It's down. What is it down today? It's down a lot. It's down 17% today. And then of course we've got palladium, which is probably down even more now from when I kind of looked at this. So palladium from this morning's high to where its low is 20% today. So I don't like platinum, palladium, silver so much. Right now I still like gold. I like equities. And I do think, and this obviously goes against the grain, I like the dollar index. I actually think we're going to see the dollar index eventually have a nice pullback or put in a nice bottom here. It has had a big pullback. It's starting to put in a rounding formation. It's had a nice rally up. Now it's starting to pull back into support. And I think we're going to start to see it kind of rise from the ashes. It's still putting in a big base, kind of a stage one base and trying to figure itself out here. So I kind of like those plays. Other than that, I think cash is going to be a position that's going to be used quite a bit in 2016 where we can get in, we can catch a move in a specific sector or index or commodity. Potentially bonds come to life, TLT. But I think there's going to be a lot of pockets here where we move to cash, we collect interest while we're waiting for some setups. It's not about always being in a trade, and people always think you have to be diversified, you got to have a whole bunch of stuff and positions to make money. But when the market is not moving higher, the more positions you have, the more you lose. So if we go into a bear market, most assets go down. We go into an economic reset. There is no real safe haven. And cash is one of the most powerful plays. It's much better to make 4% on the year than it is to lose 34% on the year. You don't need to hold stuff and watch your money vaporize, right? So this is going to be the year of rotating between, I think, stocks, bonds, currency like the US dollar, and a cash position, and then doing, adjusting our precious metals play as we go, maybe moving out of those or not. But there's not a whole lot that I like. I think gold and stocks have a little bit of upside, and then we'll be moving out, and potentially the dollar or a cash position could become a temporary play. But when we do go into a bear market, that's when we'll move to an inverse ETF. So as the stock market kind of plummets, we'll be able to benefit from the falling pricing, which is a pretty epic feeling. But bear market ETFs and inverse ETFs really only work well during a bear market. And so we need a lot of damage. The stock market needs to break down in a big way, probably 15-20% from here before it even triggers a true bear market in the scenario that we look to trade.
Periods like this reward patience more than boldness. Not every market environment requires constant exposure. Cash, often overlooked, becomes powerful when volatility rises and trends weaken. Preserving capital allows flexibility to re-enter later at better prices or rotate into stronger assets. Gold may prove more resilient than silver or platinum, while equities could still grind higher before rolling over. But once trends decisively break, defense matters. Successful investors accept giving back a final rally to avoid devastating drawdowns. This phase isn't about excitement. It's about discipline, adaptability, and preparing for the next true opportunity.